For most people, money is a scorecard measured by a monthly deposit. They look at a paycheck, see a number, and believe they are looking at their wealth. This is the first and most expensive illusion a person can hold. A salary is not wealth. A salary is a transaction. You trade your time for cash, and the transaction ends the moment the check clears. The wealthy, by contrast, do not measure their financial lives in paychecks. They measure them in control. Control over assets, control over debt, control over legal structures, and control over the timing of every cash flow that enters or leaves their world. This difference in perception is not a matter of scale. It is a difference in kind. The rules of money that the wealthy learn early are not about working harder or saving more. They are about understanding the architecture of the financial system and building a life that sits inside that architecture, not outside of it waiting for permission. One of the most powerful reframes is the distinction between income and cash flow. An ordinary person looks for a job with a high salary, believing that more income is the direct path to more wealth. A wealthy person looks for assets that produce cash flow. Income stops when you stop working. Cash flow continues whether you are asleep, traveling, or retired. This is not a motivational phrase about passive income. It is a mechanical reality. A piece of real estate produces rent. A bond produces interest. A business produces profit distributions. A portfolio of stocks produces dividends. These cash flows arrive on a schedule, independent of the owner's labor. The wealthy learn early to acquire assets that pay them first, not assets that require them to show up every morning. The goal is not to have a high income. The goal is to have a cash flow machine that operates without the owner's daily presence. This leads directly to the second rule. Equity is superior to income in every meaningful way. An employee trades their time for wages. A founder trades their time for equity. The difference is that wages have a ceiling, while equity has infinite upside and, more importantly, control. Equity is ownership. It is a claim on the future profits and future decisions of an enterprise. When you own equity, you participate in the growth of the entire machine, not just your role inside it. Consider the early employees of a company that goes public. The ones who held equity become wealthy. The ones who took higher salaries and no equity are still working. The wealthy understand that a dollar of equity has a different economic gravity than a dollar of salary. One is a cost to be minimized by the business. The other is a stake in the business's success. When you negotiate for equity, you are negotiating to become an owner, not just a cost center. The third rule is that debt is not a disease. It is a tool, but only when used to acquire productive assets. The ordinary view of debt is that it is a burden, something to be paid off as quickly as possible. This is true for consumer debt, the kind used to buy depreciating goods like cars and electronics. That kind of debt is a trap, but productive debt is a lever. It is the mechanism by which you acquire an asset that produces a return greater than the cost of the debt. If you borrow money at 4% to buy a business that returns 15%, you are not in debt. You are arbitraging the system. You are using someone else's capital to generate your own wealth. The wealthy learn early to distinguish between the debt that makes them richer and the debt that makes them poorer. They avoid the latter and master the former. They understand that inflation erodes the real value of fixed-rate debt over time, making long-term productive debt one of the most powerful wealth-building tools ever invented. The fourth rule is that cash flow is king, but capital is the throne. Cash flow pays the bills and funds the lifestyle. Capital is the accumulated mass of assets that produces the cash flow. The wealthy do not spend their capital. They spend the cash flow that their capital generates. This is the principle of preservation. If you have a portfolio of $10 million and you sell $1 million of it to buy a house, you have reduced your capital base. Your cash flow will permanently decrease. If instead you borrow against the portfolio to buy the house, you preserve the capital and pay the loan with the cash flow from the assets. The wealthy understand that capital must be protected at all costs because it is the engine. Spend the interest, never the principal. Spend the dividends, never the stock. Spend the rent, never the building. Taxation is the fifth rule, and it is perhaps the most misunderstood area of personal finance. Ordinary people think about taxes in April. Wealthy people think about taxes every day of the year. They do not think about tax evasion, which is illegal. They think about tax optimization, which is entirely legal and is built into the structure of the financial system. The tax code is not a simple deduction from income. It is a set of incentives designed to encourage certain behaviors. Investment in real estate is incentivized through depreciation and interest deductions. Investment in businesses is incentivized through capital gains treatment. Investment through retirement accounts is incentivized through tax deferral. The wealthy structure their affairs to fit within these incentives. They do not pay taxes on their income first and then invest what is left. They invest first, and then they are taxed on what remains. This timing difference, executed over decades, creates a staggering gap in net worth. The sixth rule is that you do not build wealth by selling assets. You build wealth by using assets as collateral. This is the principle that many people never learn. They think the way to become rich is to buy a house, watch it appreciate, and then sell it for a profit. But selling triggers a taxable event and removes the asset from your balance sheet. The wealthy buy assets and hold them. They use the appreciating value of those assets to borrow money at low rates. They use that borrowed money to buy more assets. This cycle of acquisition and borrowing is how real estate empires are built and how dynastic wealth is preserved. You do not sell the machine. You borrow against the machine to buy another machine. The first machine pays for itself and the second machine pays for itself. You own them both, and you own the debt against them, which is another asset entirely because the debt is secured by assets that grow in value faster than the interest accumulates. The seventh rule is that liquidity is a luxury. A wealthy person is not someone who has a lot of money in a checking account. A wealthy person is someone who has a lot of assets that can be converted to cash quickly and efficiently, but they also know the danger of holding too much cash. Cash is a melting asset. Inflation erodes its purchasing power every single year. The wealthy hold just enough cash to cover near-term obligations and opportunities. The rest of their net worth is deployed into assets that grow with or outpace inflation. They understand that cash is a liability on a balance sheet, not an asset that grows wealth. It is a tool for transactions, not a store of long-term value. Eighth rule is the power of ownership. This is the core realization that changes everything. You can be the highest paid employee in a company and still be less wealthy than the owner of the company next door. Ownership is the accumulation of equity in anything that produces value. It is owning the land, the building, the platform, the brand, the customer list, the software code. The wealthy learn early to trade their labor for equity whenever possible. They take lower salaries to get more stock. They invest their savings in index funds that represent ownership of the entire market. They buy rental properties because they own the real estate. They buy businesses because they own the cash flow. The moment you shift your identity from a worker to an owner, you shift your relationship to the economy. You stop being a cost and start being a claimant. The ninth rule is that control of a business is worth more than a percentage of a business. A 49% stake in a company is a financial asset. A 51% stake is a power asset. The wealthy understand that control determines the direction of the company, the compensation of executives, the timing of a sale, and the distribution of dividends. Control allows you to protect your minority shareholders or to squeeze them. It allows you to steer the ship into profitable waters. This is why founders fight so hard to retain voting control even after they sell shares to the public. They understand that equity without control is just a piece of paper that fluctuates in value. Equity with control is a kingdom. The 10th rule is the value of reputation. In the world of high finance, reputation is not a soft concept. It is a hard asset. It determines who will lend you money, who will invest with you, who will sell to you on credit, and who will buy from you without extensive due diligence. A damaged reputation closes doors. A pristine reputation opens them. The wealthy understand that a single act of dishonesty or a single legal violation can destroy decades of relationship capital. They protect their reputation the way they protect their balance sheet, because in many ways, the balance sheet is a reflection of the reputation. No one lends $1 billion to a person they do not trust. The remaining rules follow from these foundational principles. The wealthy learn that relationships are a form of leverage, that networking is not socializing but capital allocation, that you do not build a business to sell it, but to create a permanent machine of cash flow. They learn that negotiation is not about winning a point, but about creating a structure where both parties feel they have gained. They learn that you do not manage money, you manage risk, and money is simply the unit of measurement. They learn that one deep specialization often creates more wealth than a dozen shallow skills. They learn to say no to almost every opportunity that is not aligned with their core thesis. They learn that hiring people smarter than yourself is the only path to scale. They learn that assets are bought in despair and sold in euphoria, and that it takes immense psychological strength to act against the crowd. They learn that trusts and legal entities are not tax dodges, but protective structures that ensure the family's wealth survives marriage, divorce, lawsuits, and incompetence. They learn that you must pay yourself first, not as a luxury, but as a business expense because the entity must allocate capital to its owner to survive. They learn that inflation is a hidden tax on the unprepared and a silent ally of the borrower. They learn that the government creates the rules, but that those rules are not fixed. They can be navigated and optimized. They learn that cash flow is predictable, but capital appreciation is not, so they rely on the former and let the latter be a bonus. They learn that the rich do not work for money. They work for the power to move money, the power to make decisions, and the power to structure outcomes. They learn that financial education is not a one-time course but a lifelong pursuit because the system changes. They learn that wealth is not the point. Wealth is the fuel for autonomy, for freedom, for the ability to say no to what you do not want and yes to what you do. They learn that no one is coming to save them, that the responsibility for their financial life rests entirely with them. They learn that the system rewards patience, not urgency. And finally, they learn that the rules are available to anyone who takes the time to study them. But most people never will, because studying the rules of the rich feels like a betrayal of the moral story they were taught. The story that says working hard is the only virtue and that wealth is an accident of luck. The wealthy know it is not luck. It is a deliberate, conscious, and relentless application of these rules, day after day, decade after decade. And in the quiet moments when the family office is closed and the portfolio is secure, they know the greatest rule of all. Money is not the goal. Money is the tool that buys time, and time is the only thing you can never earn back.